Good morning, everybody. Good morning, all you magnificent melonheads of the world, and happy Tuesday, everybody. Today is March 4th, 2025. And the top story this morning, if you go in the financial press, it's all tariffs, tariffs, tariffs. And yeah, tariffs is big news today. But, you know, we all knew the tariffs were coming. There's not really any new developments in tariffs. So we're not going to spend a lot of time on that today. It is what it is. So the top story in non-tariffville this morning is Tesla. And Tesla's absolutely abysmal sales numbers in China. Guys, Tesla has a big problem here. And, you know, we're talking about the $1 trillion club. We're talking about a Mag 7 name. BYD is eating their lunch in China. And BYD is a pig. And so they're not just eating Tesla's lunch. BYD is eating everybody's lunch in China. And they're also eating everybody's lunch in Europe as well. These Chinese-made EVs are creating a huge problem for the Western EV makers. Now, look, the whole EV space, despite growth in EV sales worldwide, it's been way over invested for the last couple of years. I mean, the Cathie Woods of the world just took things way too far. There was way too many government subsidy programs. They forced it down people's throat, and the market is now starting to adapt to a more reasonable expectation for continued growth in EVs. All right. They are going to continue growing, and they are going to continue capturing market share from internal combustion engines. But there are certain markets that EVs are just never going to penetrate, or not without some major breakthroughs in technology that just aren't here yet. Now, on top of this, Tesla has an Elon problem, or Elon has an Elon problem. Look, Elon Musk's, we're not going to get too political here, but Elon's politics are what they are these days. Elon has aligned with a certain political segment. And let's just say this political segment that Elon has aligned with is not the political segment that buys Elon's cars. Not even close. All right. Republicans are not what made Tesla what it is today. It's like, let's just be realistic about this here, guys. All right. Now, I'm not picking sides in this whole thing. You can probably figure out where I lie on the political spectrum, but this just isn't good business. When you sell cars predominantly to the left and then you align yourself with the right, you can expect a major segment of the left is no longer going to buy your cars. So Elon doesn't just have a problem with China sales. Elon very soon is going to have a problem with US sales. And look, guys, we're seeing charging stations are being sabotaged all over the country. Tesla dealerships are getting firebombed. People's Teslas are having crap thrown. They're being vandalized. All these celebrities are like, I'm giving up my Tesla. And freaking Elvira the other day posted a video of her Tesla being hauled away with "F you, Elon" or something written on the side of it. And like the point is, when you alienate your base, your business has a problem. And if you think I'm kidding, look at what happened with Star Wars when they embraced this whole radical feminist movement with Kathy, what was her name? Oh my God, she's finally gone. Good riddance. Kathleen Kennedy and the whole like forces female thing that she was doing over there. Little girls are not what made Star Wars famous. And I'm all for reaching out to new markets. But when you reach out to new markets by pointing at your old market and saying they're a bunch of backward, hate-mongering bigots and misogynists, don't expect them to buy your toys. And little girls are just not going to buy Luke Skywalker action figures like they did in the 80s. It doesn't work that way. So Tesla's got real problems here. That is a name I would not touch with a 10-foot pole for a while until this dust settles. And to be honest with you, the way the left takes things personally, some of those people may never come back. Also going on this morning, we've got OPEC Plus. Big news, something else that's not exactly going to be good for EV sales. OPEC Plus is increasing oil production in April. They are finally beginning to normalize. Now, this was supposed to begin back in October, and they've been pushing it out because of global demand worries, where now they're finally getting this underway. The next 18 months, starting in April, OPEC Plus will be increasing oil production by a small amount every month. And look, this is going to be very deflationary. The oil price right now is already testing lows going all the way back to 2022. Now that production is going to increase, it looks like oil is headed back to the high 50s at least here. This is going to be very deflationary, very disinflationary. So we've got this tariff thing is happening. You may have heard a lot of talk about tariffs. That the tariffs is going to bring up core inflation, the price of finished goods. But at the same time, cheaper oil prices, that's going to bring down energy. That's going to bring down headline inflation. I don't know which one of these forces is going to be greater eventually. Tariffs will get here first. Then the lower oil prices will get here several months after that. Now, on top of that, after several months of sustainably lower oil prices, we should begin to see core inflation come down, partially offsetting some of those tariffs. But this is a major disinflationary force that has now been added to markets, and it's just going to take time for it to work its way through the system, and we'll see what it looks like. Also, in the AI space, my favorite company in the whole world, CoreWeave, has filed for their initial public offering. They're taking it public. We all knew this was coming. The top is in this AI bubble. Mark my words, the CoreWeave IPO marks the beginning of the end for the AI mania. They filed yesterday. They're seeking a $34 billion valuation. Look, they're a GPU rental company. They buy GPUs and they rent them out. That is their business model. They're up to their eyeballs in debt. They should have IPO'd last year. In my opinion, the CoreWeave guys got a little bit too greedy. They waited too long. They kept jacking up that valuation. And now we've got Microsoft, their biggest customer, is canceling data center projects all over the world. Do you really think those contracts with CoreWeave are safe? Now, CoreWeave has seen explosive revenue growth over the last couple of years, but you know what they haven't seen? Any profit. If they're already not profitable, and if this bubble is about to burst and their biggest customer is about to cancel contracts, well, let's just say I won't be tripping over myself to buy this IPO. We also got earnings from Target today. Target is down on expressing consumer uncertainty, weak guidance, and tariff risk. And then Best Buy also reported this morning, stop me if you heard this one, they expressed consumer uncertainty, weak guidance, and tariff risk. I'm beginning to see a consistent theme here. Again, tariffs, we're not going to talk too much about them, but all these other stories that we're talking about kind of overlap with tariffs. Consumers have big problems here. Tariffs are going to be very inflationary. I don't know if you heard that one. But guys, there's going to be a big jump coming in the next few CPI prints from these tariffs. Will it be sustained is the big question. We've already got worries about consumer inflation expectations. We saw that in the last few Michigan surveys. They're going vertical here. So if there is a big inflationary shock, it could affect people's mentality and consumer inflation expectations. When they become unanchored, to use Jerome Powell's terminology, it can become a self-fulfilling prophecy. So keep an eye on that inflation story for the next couple of months. And over the next couple of days, we're going to get a lot of labor data. Macro Edge just came out with their job cuts tracker for the month of February. 151,000 job cuts were announced in the United States in February. That is up sharply from 80,000 that were announced in January. Look, the layoffs came late this year. Typically, big tech and a lot of those firms, they announce all their big layoffs in January. For whatever reason, they didn't this year. They announced them in February. And this is all leading up to that all-important non-farm payrolls report that comes out on Friday, arguably one of the most important statistics in all of finance. We got a lot to talk about this morning. Why don't we shrink my big melon of a head and let's see what's happening in the world. And if you please hit that like button and that subscribe button for the YouTube algorithm, because we do this one every morning. So come and have your coffee with the melon heads. And right now we've got markets are pretty much down across the board here. The S&P is off by 26 points, a little less than 0.5% lower. The Dow, meanwhile, is off by 100 points, a little less than 0.25% lower. And the NASDAQ is down 77 points, about 0.38% to the downside. So we got all three indexes are in the red this morning. We've also got a lower dollar, a weaker dollar here. That's interesting. The DXY is off by about 45 cents here, 106.1. We were in a 105 handle for quite a while here. So that weaker dollar will put somewhat of an upward pressure on asset prices, although it's not really helping stocks this morning. Looking over at the bond market, we've got yields are lower again. We've been seeing yields move consistently lower for, well, a couple of days in a row now. Not a big move, but another move to the downside. The 30-year Treasury, 4.463, off by a fraction of a point. The 10-year, 4.155. That's off by 2.5 points. The 2-year, 3.896. That's off by 8.5 points. Big move lower in the 2-year this morning. That's interesting. And the 1 month at 4.315, off by a fraction of a point. So yields continue to head lower. People continue to buy bonds for safety. And we've also got metals are looking pretty good this morning. Gold is up by $25.66. That's for spot gold. Futures back above 2,900 here, $2,918.48. That's up about 0.88%. And silver, spot silver is at 31.88. That's up by about 19 cents or 0.6% higher. I like the shiny. Copper is down by about 0.2%. Platinum is unchanged. Palladium is off by 1%. And WTI is lower here, $67.79. That's off by about 60 cents for April WTI futures, or about 0.85%. We'll get more into oil in just a minute, but first we got to look at Bitcoin, and we have got some ugly candles in Bitcoin here, guys. Currently sitting at $83,025 as priced on Coinbase. This time yesterday we were talking about this big green candle off of Trump's strategic crypto reserve announcement, and some of the shenanigans and shady trading that were taking place around that announcement. And, well, if this big red candle isn't one gigantic middle finger to the crypto world, I don't know what is. Look at that. That is an ugly pattern right there. Bitcoin basically instantly gave up all the gains from Sunday, heading even lower today. And now we are once again flirting with this 200-day moving average shown in red. Watch this level here, guys. Bitcoin is on the brink of a major technical breakdown. If we lose this level, Bitcoin is heading back to the high 60s. Now let's talk about what's going on in oil. This one in Barron's from yesterday. Oil stocks fall hard after OPEC moved to boost production. Oil stocks dropped sharply on Monday after several members of OPEC and its allies said they expect to start raising production next month, which could push the market into oversupply this year. It's a serious negative for the oil market, given that oil demand is rising too slowly to sop up all of the extra supply that could come onto the market over the next several months as countries such as Saudi Arabia boost production. Now, they give us some numbers here. OPEC and a companion group known as OPEC Plus, which is basically OPEC and Russia, have been holding some of their production off the market since early in the COVID. Today, the group is still holding back more than 6 million barrels per day, or about 5% of global production. That's important to understand, guys, as oil has been sitting here, fluctuating between the high 60s and the low 80s. 6 million barrels per day has been withheld from the market. That is a huge amount of oil that have been artificially suppressed in order to artificially prop up prices. And now that is going to start going away. It agreed in December to start bringing back some barrels of oil in April, and their announcement on Monday reinforced that decision. 8 members of OPEC and OPEC Plus will begin restoring production starting in April at a rate of about 120,000 daily barrels per month. So that's a little confusing. They're going to increase production by 120,000 barrels per day every month for the next 18 months. Ultimately bringing back about 6 million barrels. I didn't do the math. I hope that works. Let's see. What's 1.2 times 18? Oh, that's about 2 million barrels they're going to bring back over the next 18 months. All told, they will be adding about 2.2 million barrels over that period. That is on top of the production boost coming from other areas of the world, such as the U.S. and Brazil. So look, more supply hitting the market. Demand is growing, but demand is growing very slowly. That means lower prices. And coincidentally, we've got the world's biggest dividend has just been cut. Here's why. Saudi Aramco slashes their payout to $85 billion for 2025. This one just this morning. Saudi Arabian oil company has slashed its massive dividend payout, the world's biggest, as the state's oil producers' profit fell amid struggling oil prices. Also known as Saudi Aramco, the company reported net income for 2024 fell to $106.2 billion, down from $121.3 billion in 2023. Those lower oil prices took a big dent out of Saudi Aramco's net income. Standing out in the report, though, was Aramco's dividend payment. It expects to pay out a total of $85.4 billion in 2025, sharply below the $124.2 billion it paid out in 2024. Aramco's dividend is the world's largest, according to FactSet. Its dividend is split into a base payment and a performance-linked payout. So we got supply is increasing. The world's biggest oil company is cutting their dividend. And when you look at this chart, you can kind of see what is on the horizon for oil prices, guys. Right now, this is WTI we're looking at. It's about $67.66. But notice this red line. We've teased and, toyed around with this line a couple of times over the last 6 months or so. These are daily candles that we're looking at. But if we zoom way out on this chart, you notice that red line, that horizontal red line, that acts as support / resistance going all the way back to March of 2021. This is a very important technical level, and now that production is going to start increasing, it looks like we are going to break down below it, and the next support level is probably not even into the 40s here. Look, it's a good bet oil's heading back to the 50s at the very least, guys. Be careful in this space. And, of course, cheaper oil, not going to be good for Tesla. Tesla's China-made EV sales fall to the lowest since August of 2022. And some of these numbers are really bad. Tesla's sales of its China-made electric vehicles dropped 49.2% in February from a year earlier to just 30,688 cars. That is the lowest since August of 2022, as the U.S. automaker faces pressure from Chinese rivals in a relentless smart EV price war. Guys, 49.2%. They have been cut in half over the last year. Tesla doesn't have a little problem in China. Tesla is bleeding to death in China. Tesla, which makes its Model 3 and Model Y vehicles in China, sold 93,926 Chinese-made vehicles worldwide in the first 2 months. That's down 28.2% year on year, according to data from the China Passenger Car Association. So we're looking at the monthly sales were down 49% versus a year ago, but the yearly sales down 28.7%. That means that this decline is accelerating as it progresses. January to February sales, though, they're saying were distorted by the Lunar New Year holiday shifting from February of last year. Okay, maybe that made things worse. Still, Chinese rival BYD, with its Dynasty and Ocean series of EVs and plug-in hybrids, recorded a 90.4% increase in passenger vehicle sales to 614,000 units last month. So Tesla sales cut in half. BYD's sales almost double. You see what's happening here, guys? Tesla cannot compete with BYD. And this, Tesla has their unique political problems that I won't get into again, but this is not just a Tesla problem, BYD. BYD is also a problem for names like Rivian and everybody else who's trying to sell an electric vehicle in China. But of course, when you hear EVs, you automatically think Tesla. And so that stock is down another 4.2%, 4.3% lower ahead of the opening bell here. $272. That's down by about $12. And year to date, Tesla is now off by about 30%. It has been a rough start of the year for the Mag 7 giant EV maker. Now, let's talk about this one, the company I just love to talk about. NVIDIA-backed CoreWeave files for their IPO after 2024 revenue surge. Oh boy, here it is. The top is in, guys. CoreWeave, an AI-focused cloud provider with backing from NVIDIA, filed late Monday for an initial public offering with plans to trade on the NASDAQ under the ticker CRWV. I guess the ticker NGMI was not available. CoreWeave is likely to be among the biggest tech IPOs this year. New Jersey-based CoreWeave rents cloud computing power with NVIDIA chips to AI developers. The company has seen a big jump in sales as companies race to train AI models. CoreWeave's revenue grew more than 700% year over year to $1.9 billion in 2024, according to its IPO filing. But the company posted a net loss of $863 million for 2024. All right, look, amazing revenue growth, 700%, $1.9 billion in sales, but they lost $863 million. These guys aren't profitable. They're nowhere near profitable. All right, not even close. The company has not yet listed the number of shares or the price it will target in the listing. Bloomberg reported last week that CoreWeave's IPO filing was imminent, with the company likely seeking a valuation of $35 billion. CoreWeave raised private funding in November at a reported valuation of $23 billion. Now, look, November, $23 billion, today, $35 billion. You know what happened since November? You had the DeepSeek announcement. You had the shocking realization that the demand for computing power is very soon going to be nowhere near what they speculated it was going to be, because the Chinese figured out how to do it with much less equipment. And when something like that happens, your valuation, if you rent GPUs, typically doesn't go up after that. And yet they're trying to increase their valuation by almost 50% to take the company public. They are trying to sell Magnetar's bags to somebody. I don't know who. It's not going to be me. This is, however, going to be the biggest IPO of the year. And I just want to remind everybody that still nobody in the mainstream press has asked any questions to the CoreWeave executive management team about why they used a network of 20 to 60 shell companies in the Cayman Islands to trade carbon credits back when they worked for NatSource. Still don't know nobody still asked anything about that. Maybe there's perfectly legitimate legal explanations for why you would run carbon credits through shell companies in the Cayman Islands, but there's also plenty of illegitimate reasons why people do that. As a matter of fact, criminals all over the world do things like that. Well, maybe somebody would ask a question about that. But instead of asking questions, the mainstream press told everybody, don't ask that question, just mindlessly buy stock. That's a bold strategy, Cotton. Let's see how it plays out for him. CoreWeave IPO, $35 billion. Meanwhile, Target warns that tariffs and consumer uncertainty will hurt profit. We're going to hear a lot about this in the coming days, guys. Target warned that its profit would come under pressure in the current quarter, and its sales could be flat this year because of consumer uncertainty and escalating tariffs. The retailer sales in February fell year over year because of declining consumer confidence and cold weather. Target Finance Chief Jim Lee said those sales trends should tick up as weather warms and the Easter holiday spurs buying. Lee said, but the retailer will remain appropriately cautious with our expectations for the year ahead. And look, we've talked about this for a while. Target is losing market share to Walmart. We're seeing people trade down. Wealthier customers are being forced down the quality ladder because of inflation, and they just can't afford to shop at higher-end retailers anymore. U.S. consumer confidence is slipping in part because of fears that the Trump administration's tariff campaign could raise prices. Okay, that's accurate. Tariffs aren't helping things, but that's not the biggest cause of the slipping consumer confidence. Consumers have no confidence because consumers are freaking broke after what inflation has done for the last 5 years. Walmart executives spooked investors last month when they set fiscal year revenue and profit targets below analysts' expectations. Target said comparable sales for stores and websites operating at least 12 months rose 1.5% in the 3 months ended February 1st. That's below the rate of inflation, so that's a decline in real sales. That was in line with what the company predicted in January when it reported holiday sales results. Profit also came in largely as expected. The growth was driven by stronger sales of beauty products and some big sales over the winter holidays, as well as through same-day delivery. Target stock is not doing so good this morning, down about 2.5%, trading at $117.80. That's off by almost $3, and Target shares are down by almost 10.7% year to date. Another name struggling for the exact same reasons this morning. Best Buy forecast muted annual sales and profit on soft electronics demand. Best Buy forecast annual comparable sales and profit largely below expectations on Tuesday, indicating that cautious spending by Americans on high-priced items such as appliances and gaming consoles could persist among tariff woes. Well, tariffs, again, they're not going to help, but that's not why people aren't buying gaming consoles and appliances. People aren't buying them because they're broke, because life got so expensive and their wages didn't go up. Thank you, Federal Reserve. Shares on the top U.S. electronics retailer reversed earlier gains to drop 2% in pre-market trading. Major U.S. retailers, including Target and Walmart, have preferred to provide cautious forecasts, citing uncertainty around President Trump's latest tariffs. There's those Trump goggles again. As we enter fiscal year 26, we believe consumer behavior will be largely similar to last year, remaining resilient but still dealing with high inflation that is driving expenses up across their lives, making them value-focused and thoughtful about big-ticket purchases, Best Buy finance head Matt Billinus said. And Best Buy shares doing pretty much what Target shares are doing, off by 2.6%, down about $2.29, and trading at about $84.45. And we've also got this one from my friends over at MacroEdge, their MacroEdge job cuts tracker. These guys keep track of all the announced layoffs and buyout packages, all the jobs that are being cut in the market, and then they compile them at the end of the month to create a picture of how much job cutting is going on in the market. And you can see we had a big jump in February. MacroEdge job cuts tracker, 151,000 job cuts were announced last month, up sharply from roughly 80,000 that were announced in January. Now, I was kind of expecting the layoffs would come in January. Historically, that's when we've had the big jumps, like because big tech usually does their big layoffs. A lot of financial firms do their layoffs in January. For whatever reason, it didn't happen. Now, that was good, but of course, now they're happening in February. And look, we got a lot of labor data coming out. We got JOLTS coming out. We got ADP payrolls coming out. We got job quits are coming out over the next few days. And then ultimately, Thursday, we got initial and continuing jobless claims are coming out. The big one on Friday, non-farm payrolls. That's going to move markets, guys. Right now, I'd say with all the tariff talk and all the, inflationary stories that are going, I'd say inflation has kind of regained the lead as the biggest issue in finance right now. You've also got the big sell-off in tech that's been affecting things. But I think inflation is a big concern here. The jobless number, the jobs has kind of fallen by the wayside a little bit, even though for a while there, it was all about the jobs numbers like late last year. So Friday's going to be important. If we keep seeing these rising inflation expectations and these higher CPIs and PPIs, and then at the same time, we start to see job losses or lower than expected job gains, that word stagflation may start creeping into people's vocabularies. Now, again, typically stagflation is rising unemployment and rising inflation. We're not really seeing that right now. Neither trend, like unemployment is kind of treading water right now. It actually ticked down a little bit in the last jobs report, but we are seeing inflation rising slowly here for the last 3 or 4 months in a row. So it's going to be important. If the MacroEdge job cuts tracker is accurate, then we should see a slight increase in the unemployment rate and rising inflation and rising unemployment at the same time. That's your stag and your inflation, J-Pal. So keep an eye on that one. And I just want to say thank you so much, Mr. Reyes. He says, EVs is old news. Where are the flying vehicles already? Popular Mechanics has promised me a flying car since the 1950s. Where's my flying car? Look, I'm okay with no flying cars. I mean, I've seen what a man with New Jersey plates can do on the road. I am not looking forward to what a man with New Jersey plates could do in the skies. So I'm okay if that whole flying car thing doesn't happen. We can watch an episode of the Jetsons and fantasize about it. But for now, I'm comfortable here on the ground. Maybe that makes me a Luddite. I don't know. But I'm in no hurry here. Look, flying cars, it's like fusion. It's been 50 years away for the last 50 years. Thank you, Armando, for the super chat and supporting the channel. And he's back. He says, if Trump can skate high unemployment and a soft depression, he might just beat inflation. I'll be honest with you, Armando, I don't think he's going to skate either one. Look, 275,000 or something job cuts from the federal workforce, that right there is about 0.2% unemployment higher by itself. I didn't even mention that with the MacroEdge chart. I'm sure a lot of those job cuts were federal jobs. But unemployment, it's heading higher here. I mean, I really think the job market, especially with consumer spending slowing down, I mean, we saw those numbers from Target and Best Buy. Both of them are worried about the consumers. Now we've got tariffs on top of that. That's not going to help consumer spending at all. I think we're probably looking at higher unemployment. And at least in the short term, we're looking at higher inflation. The tariffs is going to be one big jump in inflation. It's not going to be sustained. It's going to be a one-off. It's going to hit, and then it's going to stay there. And then eventually these lower oil prices may translate into lower inflation. So he may be able to skirt the inflation thing. I don't think he can skirt the job cuts. I really don't. I mean, so much of our job market, not just the federal workforce, but so much of our job market right now is being propped up by this ridiculous 7% of GDP deficit that the government has been running. And if they're serious about cutting spending, that means higher unemployment. Thank you, Armando, for supporting the channel. And thank you to Steve Woitis, who says OPEC front-running potential North American and Russian oil and gas supply coming back to world markets. Well, if they're trying to front run it, they're, increasing production is not how you front run that. The world is looking at an oversupply. I mean, that's what you're describing there, Steve, is more supply hitting market as OPEC increases. Russian oil and gas, Hopefully at some point that comes back, not because I want to see Russian oil and gas come back, but the only way Russian oil and gas comes back to the global market on the whole is if the war in Ukraine stops. So I hope we get to that point. That would be very good for us. But at the same time, American oil and gas production keeps increasing. And then OPEC Plus talking about increasing oil and gas production. You see a common thread here? There's going to be a lot of supply. And we're talking about how consumer demand is sluggish. Demand flat at best. So I think we're looking at sharply lower energy prices, which eventually will translate into lower CPIs. But it's going to take a while. The tariffs will get here first. That's for sure. Thank you, Steve Woitas, for supporting the channel. Thank you, T.A. Chapman, for gifting 10 Nobody Special Finance memberships. Welcome to the Melonheads, you 10 mystery people. And if you receive one of those memberships, be sure and say thank you to T.A. Chapman. Thank you, sir, for supporting the channel. You are a gentleman and a scholar. And you've also been a Melonhead for 8 months. He says, Jack, is the recession depression here? You know what? I didn't bring this one up, but we're going to do this. We're going to shrink me again because I should have had this one up. Check out GDPNow and what it has done over the last couple of days. This is the Atlanta Fed's estimate, their advanced estimate of gross domestic product. And look at what this chart has done. We went from positive, I think we were positive 2.3% GDP growth 2 days ago or 3 days ago, and now we are negative 2.8%. A massive decline in GDP estimates. So is the recession here? A big drop in GDP would suggest the recession is coming close. Right now, the textbook definition of a recession, if you're not a politician trying to redefine your way out of it, but the most commonly accepted definition of a recession is 2 consecutive quarters of negative GDP growth. We're looking at 1 quarter of negative GDP growth here. And by the way, guys, this big decline was driven largely by a huge amount of imports driving the trade deficit higher because retailers are front-running tariffs. That's what this big drop-off in GDP was. Absolutely tariff-related. We've also seen like the ISM was pretty bad yesterday, and we've seen some slowdowns in consumer spending as well. But the lion's share of this drop was from a huge surge of imports subtracting from GDP. So not a recession yet. By textbook, we would need 2 quarters of this, T.A. Chapman. That being said, the press is finally admitting, we've seen a lot of articles over the last couple of weeks in some mainstream outlets that are admitting that for 90% of the population, the United States has been in a recession since 2022. They're finally admitting that. What a difference an election makes, right? We went from the whole vibe session ridiculous talking point about, oh, the reason you think we're in a recession is because you listen to too much right-wing media. No, the reason most people think we're in a recession is because most people's lives have gotten more expensive and their wages haven't gone up. All right, so 9 out of 10 people have already been in a recession for the last several years. 1 out of 10 people are doing really well. And they're doing so well and they're spending so much money, and combined with the government's huge fiscal deficits, it makes GDP look bigger. But that is all isolated in the top 10%. So is the recession depression here? It depends on your definition, right? If you want to do your Obi-Wan Kenobi from a certain point of view, the recession has been here since 2022. Depression is a strong word. We're not in a depression, definitely not. But we could. Textbook definition of a depression, or most widely accepted, is a cumulative 10% decline in GDP, and we are a long way from that one. Thank you very much, T.A. Chapman, for the super chat and for supporting the channel, as well as for being a Melonhead. And my man, Grandpa. Thank you, Grandpa, for supporting the channel. He says Saudi cost per barrel, $10. I've heard higher than that, but the Saudis' oil cost is a lot lower than ours, whatever the actual numbers are. USA frackers cost per barrel is about 45. That is roughly in line with what I've seen. So the point being here, the Saudis' break-even price is lower than ours. And so you're hinting at the risk here, Grandpa, of a return to an oil price war like we had in 2014, 15, 16 timeframe, when the Saudis opened the floodgates and flooded the market with oil in order to try to put U.S. producers out of business. Now, that worked for a while for the Saudis. All right. A lot of U.S. companies went out of business. Commercial real estate in the Houston area collapsed when that happened because so many oil startups went out of business in the bust. They still talk about it. If you watch the show Landman, which was excellent, by the way. They talk about what it was like living through the oil bust for the people who worked in the oil patch. That was the last time the Saudis declared war on American oil production. Now, it was so painful for us, but it was worse for the Saudis. The Saudis burned through their cash stockpile like crazy because they were bleeding money the whole time they were trying to regain that market share. And then as soon as the Saudis took their foot off our neck, as soon as they stopped flooding the market with oil, the American producers just started poking holes in the ground again. They just came right back. And so the point was the Saudis lost that price war. I mean, it was a war of attrition. Nobody really wins a war of attrition, but the Saudis definitely didn't win it. It didn't work. They didn't achieve their goals. So I don't know if the Saudis are eager to relive that experience. The fact that they're cutting the dividend for Saudi Aramco, maybe not. But we're still a long way from a price war with the Saudis. They're just normalizing production right now. If we see them start drastically increasing production by huge amounts, then we start worrying about that price war. But it is absolutely something to think about. And by the way, a oil price war would be very good for inflation numbers. I'm just saying that would bring down inflation, and it would put a lot of Americans out of work because America is now an oil and net exporter of energy. But at the same time, there would be some relief with the inflationary numbers there. So thank you, Grandpa, for pointing that one out. And Spud Ruckus, could you describe the ruckus? Says housing market teetering too, delinquencies and foreclosures rising. You know, what we're seeing in the housing market, besides a trend of frozen transactions that's still in place, the lower end, the lower income brackets are really struggling the most. That's where the pain always shows up first. We're seeing the same thing in autos. And meanwhile, we're seeing high-end homes are still trading a lot. So I agree, we are seeing the housing market teetering. I am amazed for how long the housing market has been able to teeter. But we're doing a lot of things to prop up the housing market, right? Like all these things we're talking about doing with home insurance in California and Florida because insurance costs would be so high if they didn't do that. What they don't tell you is that's how they artificially inflate home prices. Because if the government programs didn't do these insurance things in order to artificially suppress insurance costs would be so high that people wouldn't be able to afford the insurance costs. And so they'd start selling those higher end homes and their prices would come down to a point where they can afford them. And, you know, if you don't carry insurance, you can't get a mortgage, which means the only way to get a mortgage for one of these homes would be if the price fell so low that now the insurers can afford to insure them at a lower cost. But like everything, we got to keep this asset bubble inflated. The floor is price discovery. Everybody jump up on the couch. And so, you know, they're doing everything they can to keep the housing market inflated. Sooner or later, they're going to fail. Rigged markets always fail eventually. Thank you, Spud Ruckus, for supporting the channel. Zebo Fritz, Melonhead for 9 months. Thank you, sir. He said, did Trump admin do economic analysis before job cuts? I'm sure somebody did, but let me just say thinking before talking, not really a strong suit for this guy. I think regardless of where you are in the spectrum, I think we can all agree on that at this point. I think seat of the pants, shooting from the hip, I don't think that's such a stretch of the imagination. But to the point here, the job cuts, there is pain associated with that. In my opinion, the job cuts are necessary. Government spending, well, this just in, the United States has a spending problem. Shocking, right? Look, we have to do something about it. And you can't do that without cutting federal jobs. So it needs to happen. But let's not act like that's just because of the necessity doesn't mean there are not consequences. And there are consequences. Those people are no longer getting paychecks, means they're no longer spending money. Means they're no longer paying rent. It means higher foreclosures. And yeah, it has a real human toll as well. It messes with families. Losing jobs sucks. So yeah, there's going to be a cost there. Now, did they do an economic analysis? I'm sure somebody did. Did Orange Man listen to it? Maybe, maybe not. Listening, probably not a strong suit as well. But to your point, there's going to be fallout from that. Absolutely. And, you know, we cannot solve a 7% of GDP deficit without a recession. Physically impossible. It just can't be done. How bad and how long the recession is going to be, I guess we'll find out. I hope we find out anyway. Thanks again, Z. And thank you to the Beekeeper who gifted 5 Nobody Special memberships. Thank you so much, Beekeeper. And guys, be sure to let the Beekeeper know you are grateful as well. And welcome to the Melonheads. Thank you for supporting the channel. Brojo's 420 Cafe. He says, just got the township tax bill in PA up over 30%. WTF. Isn't that amazing how the government is always the first to give themselves a raise, either through your taxes or through their own paychecks? Remember, your pain is a price they are willing to pay. 30% increase. But your wages went up 30%, Brojo, right? Didn't they? Oh, they didn't? That's right. Nobody's wages went up 30%. Unless you're lucky enough to be in that top 10%, then your wages are way up. Look, this is another example, right? Your tax bill goes up 30%. So you're probably going to spend less money at Target and less money at Best Buy. And I don't know if you're a Target or Best Buy shopper. I'm not making any accusations there. I'm just saying less money that you're going to spend into the economy elsewhere. So, yeah, death and taxes, brother. The only certainties in life. Thank you, Brojo, for supporting the channel. That sucks about your tax bill. And thank you, everybody, for having your coffee with the Melonheads this morning. Appreciate the generosity in the super chats, as well as thank you to my magnanimous Melonheads on Patreon and YouTube. Thank you guys for everything you do for the channel. Links down below to all that good stuff, should you feel so inclined. Don't forget that like button and the subscribe button on the way out for the YouTube algorithm. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small, dream big.